The current live intraday price for Datavault AI Inc. NASDAQ DVLT sits at $1.54, representing a substantial drop of minus $0.090 or 5.52% in today's trading session. This sharp pullback is the immediate reality confronting investors, especially coming off a recent period of extreme volatility and massive short-term gains, followed by a sudden decline just yesterday, which analysts are pegging as profit-taking after the recent run-up, combined with a broader, less forgiving macroeconomic sentiment towards highly speculative AI and data-focused firms. The expectation narrative surrounding DVLT is all about its potential, a high-growth, pure-play AI and data monetization entity transitioning from a legacy business model underpinned by a torrent of recent news about major strategic agreements, licensing deals for real-world asset tokenization, and unbelievably ambitious forward-looking revenue guidance. The stock is often discussed in the same breath as high-flying names, drawing comparisons to the kind of exponential upside seen in the early days of companies like NVIDIA stock as a pure AI play or Tesla stock as a disruptive technology firm, albeit on a much smaller and more volatile scale. This narrative of a technological phoenix rising from the ashes of a former business is what has drawn the intense spotlight and fueled the recent price swings. However, the unexpected, more complex insight here is the simultaneous existence of an incredibly bullish outlook, like the consensus analyst price target of a staggering $7, implying over 300% upside, right next to the deeply negative operational reality of a company still posting alarming losses, with a negative profit margin exceeding 1,300% in a recent quarter, and extreme operating expenses outpacing revenue significantly. This tension between a compelling forward-looking strategic vision and a difficult present-day financial reality is the core story here, and the reason for the daily volatility, making it a challenging stock for anyone performing self-investing or using a simplified online investment platform like the Robinhood app. The general market belief, particularly among retail traders who often favor high-potential, high-risk stocks accessible through modern platforms like Robinhood or SoFi Invest, is that DVLT's intellectual property and its strategic agreements, particularly in RWA tokenization, are a license to print money in the future. The expectation is that the $10 million exclusive license with Scilex Holding and the $2 million non-refundable fee plus 35% royalty deal with Nature's Miracle for carbon credit tokenization are clear signs of impending high-margin revenue streams. Management has played directly into this expectation by raising 2025 revenue guidance to a range of $30 million to $60 million and setting a 2026 target to exceed $200 million, a truly extraordinary leap from the $2.7 million reported in 2024. This kind of announcement, particularly its timing, serves as a powerful magnet for growth-oriented investors and momentum traders. But let's introduce the deeper, more cautious take, the reality check that forces a rethink for even the most optimistic trader. The bulk of this forecasted revenue, particularly the jump to $200 million in 2026, is contingent on the successful execution of dozens of complex worldwide contract negotiations for licensing its patented technologies to RWA asset holders. They are in negotiation, not yet fully executed and monetizing at scale. While the legal action taken against a prominent short seller, Wolfpack Research, for an allegedly defamatory report did initially rally retail sentiment and the stock price, a classic expectation exceeding reaction to a confident corporate defense, it also underscores the high-stakes, contentious, and often messy nature of this stock's narrative. This is not the quiet, stable growth you'd look for in a Fidelity Mutual Funds or a Schwab Intelligent Portfolios allocation. This is a pure-play bet on patent validation, massive legal risk mitigation, and hyper-accelerated commercialization across multiple nascent complex markets like biotech data and carbon credit trading simultaneously. The stock's short-term movement, today's drop of over 5% on a significant volume of nearly 10 million shares, following a broader decline, suggests that for every investor who buys into the future revenue guidance, another institutional or seasoned trader is taking profits or is simply skeptical of the pace of execution and the current burn rate. This push-pull dynamic is what makes the stock so volatile on any given day. The current downtick in a volatile, low-float stock environment indicates that a technical resistance level has likely been hit, or general market weakness is forcing a retreat, overpowering the bullish news flow for the moment. To understand the core business, Datavault AI operates on two main pillars: acoustic science and data science. The older side, acoustic science, includes patented technologies like WISA, ADIO, and Sumerian for spatial and wireless HD sound transmission. It's a relatively stable, albeit low-growth foundation. The excitement and the source of the recent extreme volatility, however, comes entirely from the data science division. This is where the AI and Web 3.0 focus lies, specifically with its cloud-based platform for experiential data perception, valuation, and secure monetization. The key product here is the patented Data Value, an AI-driven pricing engine that aims to assign a real-world financial value to enterprise data, essentially creating tradable, securitized data assets, and the Information Data Exchange, IDE, that enables the tokenization of real-world assets by linking physical assets to immutable metadata objects. This model is highly intellectual property dependent, which is why the ongoing lawsuits and the talk of dozens of patent licensing negotiations are so central to the investment thesis. Companies looking for high-level stable data solutions would typically turn to established enterprise vendors, but the promise of leveraging blockchain and AI for new data monetization streams is what DVLT is trying to capture. For an individual brokerage account holder, this is a technical moat, the patents, that could either yield billions in licensing fees or be rendered worthless by legal challenges or technological workarounds. When we look at the trading volume, the recent surge to over 50 million shares traded on some days, compared to an average volume that is also elevated, is the clear fingerprint of heavy retail speculation and short-term institutional trading around specific news items, the short report, the lawsuit, and the raised guidance. These movements are driven less by the slow grind of traditional valuation and more by sentiment, technical analysis of momentum, and news arbitrage, which is exactly the kind of environment that thrives on platforms like Robinhood or through the fast execution of interactive brokers trading. Institutional ownership, while growing, still sits at a relatively low single-digit percentage, which means the stock is highly susceptible to the flow of retail money and the short seller community's focused efforts. The fact that the stock rebounded sharply after the lawsuit news in November 2025 on high volume is a strong signal that the narrative momentum is currently siding with management, at least in the short term, but today's drop reminds us that the technical trend remains highly fragile. For anyone who uses a more full-featured platform like Fidelity Trading Platform or the advanced tools of interactive brokers trading, the ability to analyze Level 2 data and institutional flow is critical here, as this stock is not trading on simple fundamentals right now. Looking ahead, the future outlook for DVLT is binary. Either the strategic deals and patent licensing contracts convert into the tens of millions in upfront and recurring revenue that management has guided for, validating the $7 price targets, or the execution stalls, legal and operational costs eat up the cash secured from recent financing rounds, including the $150 million strategic agreement with Scilex, and the stock reverts to a valuation closer to its negative book value. The key catalyst is the conversion of those dozens of RWA negotiations into executed, revenue-generating contracts, specifically in the tokenization space. The company's expansion of its data exchanges like the new biotech exchange and the integration of its AI agents, such as Datavault Bank being built with an IBM Platinum status, provides the technical framework. However, the execution risk in these complex, highly regulated sectors is immense. A key opportunity that might exceed some investors' expectations is the sheer size of the total addressable market they are aiming for. RWA tokenization is often cited as a multi-trillion-dollar opportunity. If Datavault AI's patented IP is truly the essential on-ramp for a significant fraction of that market, the current market capitalization, even with its recent volatile swings, would be a fraction of the stock's eventual worth. However, the primary risk that falls short of expectations is the persistent profitability issue. A high-growth narrative needs a plausible pathway to profitability. A negative profit margin of over 1,300% is a severe headwind that no amount of forward-looking guidance can completely dismiss. The company is actively consuming cash, which means it remains reliant on capital raises, which are dilutive to existing shareholders. This is a common situation for high-growth tech companies, but at this scale, the risk is magnified. The current price action oscillates